Gerald Lucas here with another installment of Ask Gerald, where you get your real estate questions answered. Today's question comes from Sandra. Sandra writes from New York, New York. And Sandra writes, Gerald, who are the big winners under the new tax law that just passed? Well, that's a great question, Sandra. So under the new tax law, your taxable income is likely to increase because it's changes including eliminating the personal exemption, for example. However, the percentage brackets are lower than they were before, so that lower percentage may offset the increase in taxable income. The best way to find out how it's going to affect you is to look at your tax burden under the old system versus under the new tax law and see how your burden changes under the new law. What I'm going to do now is give you 5 winners and 5 losers of the new tax law. So start with the 5 winners. The first winner are corporations, because corporate taxes went from 35% to 21%. Second winner are corporations again, because the alternative minimum tax for corporations was eliminated. Third winner are pass-through entities, or people who own pass-through entities. So taxes under the new law are reduced by a 20% deduction based on qualified business income. The fourth winner are renters. So under the new law, renters with standard deduction increasing are able to write off more than they ever have before. So married renters, for example, can now write off $24,000. And the fifth and last winner are people who make a lot of charitable contributions, because the deductions for charitable contributions increased to 60% of adjusted gross income, whereas previously they were 50%. So here are the 5 kind of losers under the new tax law. The first are borrowers and lenders of home equity lines of credit, which are no longer deductible. And HELOCs are not grandfathered in, unlike certain mortgages based on the changes. So the first losers are, unfortunately, people who have home equity lines of credit. Second are married people who buy homes with mortgages over $750,000, or single people who buy homes with mortgages over $375,000. Because of the new law caps the deductibility of mortgages at those amounts. But existing mortgages of those amounts or higher are grandfathered in. Kind of the third losers under the new tax law are people with older children or dependents. So under the new tax law, although the child tax credit doubled from $1,000 to $2,000, this is kind of sneaky. A lot of people didn't know this. Under the new tax law, it doesn't apply, that tax credit, to children over 16, and it doesn't apply to elderly dependents, because the new law eliminates personal exemptions. The fourth kind of loser under the tax law are businesses with net operating losses, NOLs, which under the new law can no longer be used against taxes paid in prior years. That's a big loss. So NOLs can only be used now against future income. And the fifth and final loser under the new tax law are people who own property in high property tax areas, particularly in good school districts, because the new law limits state and local tax deductions to a maximum of $10,000. So thanks for your question, Sandra. Good luck. For more information and tips on real estate, visit my blog at geraldlucas.com. I'm Gerald Lucas, and I'll see you again soon.